Good morning, this is Bloomberg Daybreak Europe. Happy Monday, I'm Tom McKenzie in London. These are the stories that set your agenda. Fed finale, Trump says he has made his pick for the next Fed chair, but refuses to name them. This as stocks start the month on the back foot, while Bitcoin takes another dive. Oil jumping after OPEC Plus sticks to its plan to pause output hikes in the first quarter of 2026 amid growing signs of a global surplus. And American and Ukrainian negotiators say they held productive peace talks in Florida as US Special Envoy Steve Witkoff travels to Russia this week to meet Vladimir Putin. So global equities on the back foot, as we said in the headlines. You did see European stocks actually notch a fresh record high by the end of last week, but today pointing low by 0.3%. FTSE 100 futures here in the UK also pointing low by 18 points. S&P E-minis, the picture is slightly more negative when you look at the US futures session. Of course, after a shortened week last week, the gains did come through stateside on US stocks through the end of the week. But again, it was a shortened trading week, of course, because of Thanksgiving holiday and thin volumes. Today, US futures pointing low by 0.7% on the ESP E-minis, S&P E-minis. Nasdaq 100 futures pointing low by 225 points. So a little bit more pain flagged for the tech-heavy Nasdaq 100, down 0.9%. Let's flip the board and have a look cross assets. Some really interesting moves when it comes to silver, when it comes to Bitcoin, and when it comes to oil today. The commodity space firmly in focus. The US benchmark 10-year currently yielding 4.04. Again, as President Trump teases us with his views on who's going to be taking over as the next Fed chair come next year. We should get the name by the end of this month. That is what the Treasury Secretary has told us. Yields up 2 basis points so far in the session today at 404 in the benchmark. Bitcoin then tumbling in the session today, down 5.4%. You're seeing a similar pressure on Ether and other cryptocurrencies. Back below 87,000. 80,000 is the key line that many traders in the crypto space are now watching. Brent at $63 a barrel, then getting a pop on oil prices, up almost 2% as OPEC Plus confirms over the weekend that production halt will be locked in the first quarter. Silver at a record high, just below 57 right now, up 0.8% so far in the session. We'll get more details on the silver story through this show. Let's cross over to Asia right now. Min Min Low standing by in Hong Kong. Min Min.
Hey, Tom. Yes, Asian stocks also on the back foot here this morning. We are seeing weakness in most Asian markets, particularly the Nikkei, as we digest the corporate spending out of Japan today under expectations, below 3% against estimates of about 6%. The Hang Seng, though, in the opposite direction here. That is despite the PMI data that we got over the weekend, which is seeing a weakness across the board. If you look at the official PMI, you flip the board, you can see it's a contraction for the 8th consecutive month, which is the longest slump that we have seen. Non-manufacturing PMI also contracting. This is the first contraction post-pandemic, and the private PMI as well also contracting. So overall, not looking very positive in terms of outlook for the Chinese economy as we head towards the end of the year. But interestingly, markets are shrugging that off, perhaps traders seeing this as a positive sign for government stimulus. But we are also taking a look at how Japan markets are doing, because Governor Ueda from the BOJ gave the strongest signal yet of a potential rate hike in December. And currently, traders are pricing in a 60% or so chance of a rate hike in December, a 90% or so chance in January. So regardless, that rate hike seems to be on the table, and we are seeing big moves across the bond market, especially on the 2-year, hitting 1% for the first time since the 2008 financial crisis. The yen as well strengthening about 0.4% today, heading towards that 155 level. The Japanese stock markets are not doing very well today, but the Topix Banks Index, that is a sector that's doing very well. Obviously, the banks always love growing interest rates.
Min Min Low in Hong Kong. Thank you very much indeed. Yeah, the December decision by the BOJ. Very interesting now, given the comments from Governor Ueda, and potentially a hint there in terms of whether or not a hike is coming, the next hike for the BOJ. And certainly, as Min Min was saying, assets over in Japan reacting to that. Now, President Trump says he has decided on his pick for the next Fed chair, who he expects to deliver interest rate cuts. Sources have told Bloomberg that Trump's chief economic advisor, Kevin Hassett, is seen as the likely choice to succeed current Fed chair Jerome Powell.
Are you Fed chair? Are you any closer on that right now?
I know who I'm going to pick. Yeah.
Oh, tell me, Kevin Hassett.
aren't you? OK, for more, let's bring in Paul Dobson, Bloomberg's executive editor for Asia Markets. Paul, so Trump is not saying the name Kevin Hassett. He has not landed, or at least he is not communicating who his pick is. He says he has made that pick already. What do we know about this so far at this point as we look to the end of Jay Powell's term as the head of the Fed in the first quarter of next year?
Yeah, hi, good morning, Tom. So as you said, I quite like the alternate phrase, Trump teasing us a little bit there, saying that he already knows who his choice is, but not yet giving us the name or the information. What we do know is we've been reporting Hassett is the most likely choice. Hassett obviously has a long history with Donald Trump and is trusted by him and is seen to be of a similar sort of mindset in the interest rates should be lower. He's a dove, in other words. And we also know that he did weekend television appearances where he was talking a little bit about the rumors, not giving any endorsement or one way or the other, but saying if you looked at the market reaction to the stories around last week, I was positive. The stock market went up. Treasury market also went up. Interest rate bets went a bit lower, but there wasn't any negative reaction. So, I guess the sort of ... is, so, maybe investors like this as well. I think that from a market perspective, partly that's already in the price because we already, have the story out there saying he's most likely pick, and we also knew that Donald Trump would likely lean dovish in any case. I think there's two other things to take into consideration. And one, Hassett most likely is a steepener trade for the yield curve. He would like to have lower interest rates, so that pushes down short-term interest rates. Most likely that then pushes up the back end of the yield curve because it's more inflationary, and it may encourage more supply of bonds into the market from the government as well. So that's one thing to watch out for. And two, longer term, maybe, those pressures re-emerge on the dollar, because if it's seen as too much of a sort of inside man, too much of a sort of, cozy relationship rather than independent Fed, then again, the market might not like that and become a little bit less trustful or more distrustful of those sort of financial checks and balances that the Fed provides for the US financial system.
Yes, and I said that Fed Chair Jerome Powell's term ends as Fed Chair in the first quarter. It's the second quarter, of course. It's May of 2026 when Fed Chair Jerome Powell will be stepping down, it seems, from his role as Chair of the Fed. Meanwhile, Paul, in terms of what's happening in the cryptocurrency markets, I mean, we've got to a position now, a place where Bitcoin, the selloff of Bitcoin, is often a canary in the coal mine for what happens across equity markets. Today, we're seeing similar dynamics. What is the cause of the selloff around Bitcoin today?
Yeah, well, in so much as we can never say what exactly is the cause for Bitcoin, it seems like there's a few different things that people are getting worried about. One, we've just, been through a very big period of volatility in any case, and it doesn't feel like the selling is completely over. But also, we've heard some comments from one of the employees at the company formerly known as MicroStrategy, now Strategy, talking about if, the company's sort of share price continues to fall and comes under pressure, then they will maybe need to liquidate some of their Bitcoin holdings in order to be able to pay out the dividends that are promised for shareholders. And so, that raises that sort of risk of a little bit of a spiral in terms of that asset model and the Bitcoin holdings that they're having. So people don't like that story very much. Also, out of China, there was some comments over the weekend talking about the need to tighten restrictions again on crypto, worried about the speculation that's been going on there. It seems like that was equally related to stable coins and not uniquely singling out Bitcoin, but it's sort of part of the same ecosystem. And so that's another thing that people are also nervous about. Nonetheless, big move at the start of the week. So that does send out that negative signal to the rest of global financial assets.
Yeah, Bitcoin currently down 5.5%. Paul Dobson, Bloomberg's executive editor for Asia Markets. Paul, thank you. To geopolitics, US and Ukrainian negotiators say they held productive talks on a potential peace framework, but have not achieved a breakthrough yet. US Secretary of State Marco Rubio speaking with reporters after meeting with Ukraine's National Security and Defense Council Secretary.
It's not just about the terms that ends fighting. It's about also the terms that set up Ukraine for long-term prosperity. I thought we started laying the groundwork for that, most certainly in Geneva. I think we continued that work in our communications throughout the week. I think we built on that again today, but there's more work to be done. This is delicate. It's complicated. There are a lot of moving parts, and obviously there's another party involved here that'll have to be a part of the equation. and that'll continue later this week when Mr. Witkoff travels to Moscow.
For more on this, let's bring in Bloomberg's chief Europe correspondent, Oliver Crook, from Brussels. So, Ollie, what is the latest in terms of the US-Ukraine talks? What came out of these meetings?
So as you heard from Marco Rubio, the progress had been made, but again, as we say, there's still a lot of work to be done. So that Thanksgiving deadline that we had originally set for last week, we've obviously blown past that, and so we're going to focus our attention on a few of the diplomatic events that will be happening this week. Today, we expect Volodymyr Zelensky, the president of Ukraine, to be in Paris to meet with Emmanuel Macron. Here in Brussels, the European defense ministers will meet on Wednesday. We expect Marco Rubio to actually make a trip over here to Brussels to meet with NATO foreign ministers to have discussions here in the sort of NATO meeting. But of course, many of these sort of proposals that were laid out in that original plan, that 28-point plan, include both the Europeans and NATO without really their input into that discussion. So it'll be a key moment here for the Europeans to talk to the U.S. Secretary of State and try to get their sort of their desires and their ambitions and what they'd like to see in this deal before the United States. We should say that all of this will be sort of preceding potentially that visit from Steve Witkoff. We don't know yet exactly when he'll be arriving in Moscow. There were some reports that he may leave as early as today, but I'm sure that is still a work in progress. We should say overall, Tom, since we got that 28-point plan and then that was reduced to what we understand a 19-point plan, we have not seen that living document. So we do not know yet, because this is now being done very much behind closed doors, how far apart the sides are on these issues of territory, on these issues of security guarantees. And that is obviously the absolute key, Tom, in trying to appraise how much progress is being made here. We hear that there is progress being made, but at this stage, we don't really know what this plan looks like. Of course, the key concerns for the Ukrainians, the thing that they will be sort of encouraged by, is that it's actually Marco Rubio that's sitting at the other side of the table, who has a much more traditionalist view of geopolitics, much more ideological, much more principled, particularly when it comes to the Russian threat. The bad news for the Ukrainians is, of course, their delegation head on Friday resigned, Andrei Yermak, the number 2 in Ukraine, after he was sort of ensnared in these investigations into corruption. And we should say that nothing has been leveled against him yet, but his office and his home were both searched, so he resigned on Friday to Zelensky.
Yes, it's significant, of course, domestic story for Ukraine, but percolating out to these negotiations with that impact, of course, in terms of the focus on the corruption scandal in Ukraine. EU defence ministers then meeting in Brussels today, Ollie. Presumably, these peace discussions are going to be a central part of that conversation. What are you expecting to hear from that meeting?
Certainly. In attendance will also be the Ukrainian Defense Minister, Denis Shmyhal, who will be discussing with the European defense ministers a little bit further today. We expect them to bring up, obviously, Ukraine, their own sort of defense within the European continent, the hybrid threats that the Russians have been posing. Remember, there was an explosion that the Polish Prime Minister designated as sabotage just 2 weeks ago on domestic Polish soil. So that is going to be part of the conversation. But I think, Tom, the concern for the Europeans from the very beginning and sort of their influence over this is that it is very, very limited. And for the Ukrainian defense minister, who will be here, he may not get much more than just sort of positive reassurance and positive rhetoric from the Europeans. When you look at the actual diplomatic side of things, what happened over the weekend? We had Viktor Orban in Moscow talking with Vladimir Putin, and we've also had the Belgians over the last few days really digging in on this idea that they were not really open to figuring out what to do with these Russian assets, saying that maybe, we should actually wait and see, and that actually now that there are these peace negotiations, it's actually a very delicate time, and maybe we shouldn't be touching these Russian assets. So as far as actual support that would help buttress the Ukrainian position, I wouldn't be too optimistic from the meetings today, other than potentially the rhetoric. I doubt this is going to be a major breakthrough meeting for the Ukrainians in their negotiations and what the European influence can actually be in these talks.
OK, important context. Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, thank you. Here's what else to think about this week then. Today, we're going to get more details in terms of the spending, particularly online. Cyber Monday, that's after US consumers came out in force, of course, for Black Friday, in terms of the amount that was spent across that part of the spending and shopping holiday. So today, Cyber Monday in focus. Tuesday, tomorrow, Euro area inflation. So we get a little bit more detail in terms of the inflation story of Europe, with interest rates, of course, the ECB at 2%. And on Friday, talking of inflation, we'll get US PCE inflation, that favoured gauge of the Fed, of course, ahead of the Fed's decision day, December the 10th, where markets are almost fully pricing in an interest rate cut. Nonetheless, the inflation data out on Friday will be significant in terms of that decision-making, potentially. You can get a roundup, of course, of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBgo on the terminal. Coming up, oil prices rising after OPEC Plus sticks to its plan to pause output hikes in the first quarter of next year. We'll tell you why. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Oil trading higher today after OPEC Plus confirmed it will stick with plans to pause production hikes during the first quarter of 2026. The alliance reiterated that the move is a reflection of weaker seasonal market conditions. Traders also factoring in some geopolitical uncertainty stemming from President Trump's recent statements regarding Venezuela. Let's bring in Bloomberg's oil reporter Nicholas Loire now for the context and the details around this. With oil prices up 2% in the session, what is behind? Give us some more details there, Nick, in terms of what's behind OPEC's decision to pause output in the first quarter of 2026.
You've said it already, Tom. I think the short version is that OPEC is trying to reflect weaker seasonal market conditions. That's the official reason that they've provided for why they're not adding more supply back to the market. I think the other deeper level is also to say, seasonal market conditions aside, the oil market is headed for a record glut moving into 2026. So as we end the year where OPEC has spent most of it returning barrels at breakneck speed, surprising expectations early in the year, December has come as a time to take stock and figure out what comes next. And I think we're recognizing, not just OPEC, but the market more broadly, that with so much supply coming online, maybe continuing to add at a breakneck pace may not be the best strategy. So this comes as a time for them to take stock. And that's why we're seeing a little bit of caution from OPEC and prices coming up as a result.
Yeah, after 4 straight months of losses in terms of oil prices through to November. President Trump been talking about Venezuela then. We know they've been ratcheting up the pressure. What have we been hearing from the president, Nick, and how has that been impacting the oil markets?
That's a really good point, Tom. It's still a wild card coming out of the White House. I think the short version really is that things are clear as mud. So over the weekend, Trump has already flagged that he's calling a no-fly zone in Venezuela. And we already know that there's been some aggression coming out of the U.S. with regard to ships in the area over in Venezuelan waters, right? And so a no-fly zone is the kind of thing you call when you're tempted to increase aggression, potentially even move on to land sort of like behavior. So I think that's part of the uncertainty that's making people nervous. And Venezuela is a major oil supplier, so anything that could stand to impact the supply would be bullish for markets. I will add one more note of double caution. After posting that, Trump has also added that he's actually downplaying the impact of his own social media posts and saying that, hey, actually, like, don't take what I've said earlier too seriously, right? So, as I've said, clear as mud. So, and that uncertainty is definitely weighing into oil prices today.
OK, what we do know is that we need to continue to watch the oil price movements. Oil reporter Nicholas Loire. Nick, thank you for that update. Here's some other news. Top of mind today, this Monday, of course, Hong Kong's government moving to stamp out, at least, mounting public anger in the wake of the city's deadliest fire in nearly 8 decades. Local media is reporting that the city's national security police arrested a man who started a petition demanding the government take follow-up action after the fire. Police on Sunday made 2 more arrests, a former district councillor and an unidentified volunteer at the fire site. Last week's fire killed at least 146 people and has raised questions about missed warnings. Israeli Prime Minister Benjamin Netanyahu has submitted a request for a pardon from charges of bribery, fraud and breach of trust for which he was indicted 6 years ago. In a statement, Netanyahu said that his trial is undermining national unity. However, opposition leader Yair Lapid has called on President Isaac Herzog to reject the appeal. It comes after repeated calls by Donald Trump for Herzog to issue a pardon to Netanyahu. Coming up, we're going to discuss how the UK government is tackling rising energy bills. We'll dig into the implications for households. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, in last week's budget, the UK unveiled steps to lower electricity bills by stripping out some green policy levies that favour heat pumps and electric heating. With electricity costing around four times higher than gas, the government faces the difficult task of tackling rising energy bills. Yara van Ingen of BloombergNEF's Tech and Innovation team joins me now around the set. Yara, so the cost of living remains an issue here in the UK. There's a move now by the UK government to reduce energy bills by stripping out some of these additional costs. What specifically was announced?
So currently, any UK household pays about 31% towards taxes and levies. So that's a big portion of your bill going towards that. Yeah. So what the budget has announced is to remove some of those levies. So the renewable obligation, which funds clean power, and the energy company obligation, which funds installation upgrades. So that will strip about 9.5% off an average UK household's electricity bill from April 2026. So that's sort of what we're seeing. It will be offset by some new levies, but the net reduction is 9.5% lower.
How does it change then the economics of things like heat pumps?
Yeah, so it's a policy that favours the cost of living crisis, but also at the same time makes heat pumps cheaper to run than they are at the moment. So about £140 a year will be coming off a heat pump sort of annual electricity bill. Now that brings the cost gap to gas down. As you said, it's about 4 times more expensive to run electricity at the moment. So it narrows that gap, but gas will still be £270 a year cheaper to run. So it doesn't quite bring cost parity yet.
So what other levers could the government pull?
So you could lower electricity bills further, or you could increase the cost of gas with, for example, a carbon price. But the running cost isn't the only hurdle to heat pumps being installed. The upfront cost of a heat pump is really high as well. It's about £12,000 to buy and install a heat pump at the moment in the UK. So the government is offering subsidies to offset that cost. It's offering £7,500 to households to buy and install a heat pump. And that budget should support a further 206,000 installations until 2028. And that's actually supported one of the largest growths of heat pump sales that we've seen in European markets in the last year.
When it comes to refitting or upgrading boilers, and in the UK we have some houses where the boilers are ancient and kind of falling apart, and this is a problem in terms of energy costs and household bills. Where are we in that story?
So it's expensive. It's an expensive investment, and you want to see a return on that investment. So helping that upfront cost and helping the running costs is really important, but it's not suitable for all households just yet. It takes a big install. So yeah, it will take a bit of time, but there's definitely momentum building at the moment, and we're seeing uptake rising quite highly in the UK.
Okay, Yara, thank you very much indeed. Really interesting context to one of the key lines that came, of course, out of the UK budget, what it means for electricity bills, what it means for that transition to slightly more sustainable forms of energy. Of course, Yara van Ingen of BloombergNEF's Technology and Innovation team. Let's check in on markets right now. Risk off across global equities. You're seeing that most pronounced, actually, with Nasdaq futures pointing lower right now. Here in the UK, you're looking at the FTSE as well, under a little bit of pressure. The benchmark 10-year, by the way, yielding currently 4.04, so yields are up 2 basis points. A little bit of selling coming through from Treasuries. Bitcoin back below 87,000, under pressure by 5.6%. Brent crude up on the OPEC Plus decision, currently up 2%, as you can see. And silver near those fresh record highs as well, having run up almost 100% year to date. Coming up, we're going to discuss the markets through a credit lens with Invesco's Alexandra Ivanova. That is coming up next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe, Monday, December the 1st. I'm Tom McKenzie in London. These are the stories that set your agenda. Fed finale. Trump says he has made his pick for the next Fed chair, but refuses to name them. This as stocks start the month on the back foot, while Bitcoin takes another dive. Oil jumps, though, after OPEC Plus sticks to its plan to pause output hikes in the first quarter of 2026 amid growing signs of a global surplus. And American and Ukrainian negotiators say they held productive peace talks in Florida as US Special Envoy Steve Witkoff travels to Russia this week to meet Vladimir Putin. Let's get to the markets then. Equities on the back foot, as we mentioned, risk off across stocks. That's after European equities actually notched off fresh record highs by the close last week. And of course, it was a shortened week for US markets, but you nonetheless saw green on the screen after a week of thinned out trading stateside. European futures pointing low by 0.3% today. FTSE 100 futures, as I mentioned earlier, pointing low by 13 points. S&P E-minis then, slightly sharper drop being flagged, down 0.7%. Nasdaq 100 futures looking to drop 224 points. Let's flip the board and have a look cross-asset. The meeting of the Federal Reserve, of course, comes on December the 10th. The Fed chair and who is going to be taking over from Jay Powell, of course, part of the speculation now, as President Trump says he has made his pick. 4.04 on the US benchmark 10-year yields up 2 basis points, close to 3 basis points. A little bit of selling across US Treasuries in the session today. Bitcoin back below 87,000. Traders eyeing that 80,000 level as in terms of a key level of support. And $63 a barrel on Brent, up 2% on that OPEC Plus decision to pause, of course, into the first quarter. And silver at fresh record highs after a run-up of almost 100% year-to-date, up 0.9% in the session today. Now, US stock futures then falling as cryptocurrencies plunge ahead of a slew of economic data due this week. With me now is Alexandra Ivanova, fixed income fund manager at Invesco, with a particular lens, of course, on the credit space. But Alexandra, let's get your focus first, or your views first, on the Fed. Markets increasingly betting that December is a done deal, December the 10th, in terms of the next rate cut. Is that where you see the action, or is this a question of looking out into 2026 and how the Fed adjusts potentially with a more dovish structure?
Yeah, it is a good question, because I do think December is a done deal, because we don't have a lot of data coming out between now and the Fed meeting. Most of the data will come after the meeting in terms of payrolls and inflation. For me, what's more important is what's going to happen in 2026 and whether we will get to the 3% rate that market is pricing. Given where we are in terms of the economic cycle, I do think that there is a risk that we might actually see a bit of pickup or cyclical pickup in growth. Given we have fiscal expansion, Fed is cutting, some regulatory relief is also coming. So you could argue if the growth side stays robust, we might see a little bit less of a cutting in 2026. But December is a done deal, I think.
December's a done deal, but you're suggesting that potentially markets are pricing a little bit too much easing for 2026, despite changes at the top of the Fed that we're still waiting to get details on. Markets pricing in, to your point, rates getting to about 3% in October of next year. And you think that's overdone?
I think at these levels, I think in terms of rates, we are very fairly priced, and the risk reward is probably slightly to the upside. So as an investor, you would probably think not necessarily buying bonds here for some kind of capital appreciation, but more in terms of just a carry trade.
Has the curve steepener trade got further to run, so rates higher at the long end, lower at the front end?
I've had that view. I've held that view. We have had flattening more recently, and I think that gives us a good opportunity to re-engage back with the steepening bias, given the fact that maybe, as you say, administration wants interest rates a bit lower, but that also needs some kind of inflation premium, term premium in the back end of the curve. So a little bit of steepening, I think that could happen in 2026.
Okay, so that's an opportunity, potentially, to lean into steepeners in 2026. What are credit fundamentals looking like right now?
Well, we've gone through the earnings season, and it looks like... So we have a tale of two halves. There are some parts of the market really, really struggling. So chemicals, for example, we at the desk, we constantly talk about when are we going to see the lift up and some kind of at least stabilization in fundamentals. But broadly, I do think that in terms of credit markets, fundamentals are still coming through quite strongly. And it is a surprise to the upside. But given where the valuations and spreads are, I don't think that that's going to drive future performance in credit.
But you are seeing opportunities to rotate in credit. Where is that taking you?
So yes, that's an interesting one. So most of the action that I'm spending more time is in high yield. When we have budget, we have some kind of fundamental surprises to the downside, the price action can be quite brutal. You can see that investors just stepping away, and we can move dramatically for credit markets. And the way I think about it, we had a really difficult year, obviously, from the election last year and trade wars. Emotionally, as investors, we are probably all tired. For headlines, it was good year, but
yes,
really fantastic year for asset class performance. So I don't blame the market in a way that, we are 1st of December. You just want to lock in some of these gains. So in terms of the reaction to negative surprises have been interesting. And so I'm finding places where I can rotate into that. Some of the UK names in the high yield market.
This is lower quality high yield. That you're,
high yield.
Can you give us a sense of what sectors that takes you to? You've named a region. You named the UK.
Yeah, UK. So we had the budget.
Yes.
So that has given a lot of room for some of the underperformance in terms of maybe consumer-facing names.
Consumer-facing, okay.
Yeah, gamers. Obviously, we had the tax increases from the budget as well. So I do think there are places where you can lean into that because next year we're going to get our alpha. I think those are the places where you could get an alpha. But market technicals are a bit softening. All year we talked about flows into credit. We talked about how demand is still there, but I'm seeing a little bit of weakness coming through. So December tends to be a bit of a less volatile market. I'm hoping that we will continue to clip our coupons and carry. And then next year, it's probably going to be name pickers market because broadly, in terms of the good quality names, they are very, very strong and solid.
Yeah.
But you could see opportunities.
Just before we let you go, as you talk about the UK, let's zoom out to the macro picture. How much risk premium is still priced into gilts at this point, and does that get washed out next year?
Oh, a good question. So I've had held views about the curve itself and gilt market, and I think it's coming to fruition in terms of the fact that the valuations are quite attractive, and I think the front end is probably a good place to be. The Bank of England is also almost a done deal for December, and I think we could see some more easing in 2026. I used to think the very long end would be quite a dangerous place to be. Obviously, global rates and the yield curve in itself steepening. But now the DMO is also saying we're not going to issue a lot in the long end.
Yeah.
So that's helping the long end. So I'm actually worried about the belly of the curve, how we call it. So 10-year part of the curve might actually struggle, and that's where you can think about yield curve steepening to stance.
As well, yeah, okay, really interesting. Alexandra, thank you very much indeed. US steepeners in favour. Maybe the front end to the gilt market has some way to go as well in terms of an opportunity getting exposure and views as well on consumer and gaming names, and maybe some alpha that comes through in high yield credit within that space next year. Alexandra Ivanova, fixed income fund manager at Invesco. Now, staying on the credit space, the rise in popularity of fixed maturity funds has left ordinary retail investors as the unwitting main drivers of the debt market. Corporate bonds were once of the reserve of highly paid traders, but their popularity among retail investors has raised some alarms. Let's get more on today's Bloomberg Big Take with our credit market reporter Tassos Vosos. Tassos, what is the concern then?
Hi, and thank you very much for having me. The concern is that the market is becoming so big that everyone is doing it right now, every asset manager you can name. So when you want to lure investors to you instead of the other shop across the street, what do? You just have to offer a higher yield. In order to do that, you need to buy riskier assets. So we've seen those fixed maturity funds, which in the beginning they started 20 years ago as buying very vanilla zero coupon government bonds, for example. And now they're diversified into everything you can imagine. It's junk bonds, there's additional tier funds, which is a risky type of bank debt, collateralized loan obligations. Some of them are even selling credit default swaps, for example, and assuming the credit risk. All of that is being done because there's so much competition among asset managers in order to get those flows. We're talking about $250 billion already. It's still rising. So it's a very lucrative business for them. In order to keep attracting that money, they need to raise the yield, and in order to do that, they have to boost the risk.
Yes, and as they boost the risk, of course, that raises concerns about the retail investor exposure. Is this a question then of more regulation, more transparency? What are some people in the space saying needs to happen to maybe offset some of the risk to retail investors?
Well, usually what happens in order to attract new regulation is that you have a crisis. And that's going to be the problem next time, because you're going to have regular investors, i.e. voters as well, who are going to be hit, and we're going to see them wondering where'd my money go, because these fixed maturity funds, for example, are supposed to be they're supposed to be an alternative deposit. Instead of having money in a bank and earning like a lower yield, then you take the money out of the bank, put in investments in the credit market, you earn a higher yield. Things can go wrong, though, and that's something that people don't understand on the street, is that, well, if you put money in the corporate bond market, the issuer of that corporate bond may default, for example. There needs to be more regulation. That's what people say out there in the credit space. The problem is you usually don't get regulation until things go badly.
Yes, that is a major element to this, isn't it? And maybe that's where we end up ultimately, as we have done in the past. Intriguingly, there's a role that social media and influencers have played in this move for retail investors to get more exposure to the space. What has been going on there?
Well, the people who invest in fixed maturity funds, chances are they won't listen to our conversation right now. They're not going to read Bloomberg News, or they're not going to listen to other of our competitors. What they will do is they're going to get their smartphone, or they're going to fire up their laptop, and they're going to go to YouTube, for example, or a number of different investment forums. When somebody's going to tell them, oh, you can get double the yield for your deposit instead of your deposits, do this and that. And this is how people actually started learning about fixed maturity funds in the first place. So you have pop-up adverts by asset managers, for example, and at the same time you have a financial influencer who's telling you that all you have to do is just make that extra step, and your financial goals will be fulfilled. But for a number of people, that's the main avenue of knowledge these days, if you want to call it. Social media, the internet as a whole, AI as well, people just going in AI and asking questions on how to do things. So that's opening a whole new world, and this is what fixed maturity funds are also banking on.
It's also why you need to subscribe to Bloomberg, of course, and your kind of reporting. Bloomberg's credit market reporter, Tassos Fosos, excellent. Thank you very much indeed. The subject of today's Bloomberg Big Take, worthy of your time, absolutely, on Bloomberg.com and on the terminal. Now, some other stories making the news this Monday. Switzerland has voted to reject a 50% inheritance tax on super-rich residents after wealthy entrepreneurs threatened to leave the country. Government data shows more than 78.3% of the electorate opposed the plan. The left-wing Young Socialists group launched the proposal as a way of raising funds to fight climate change. But the plan ran into staunch opposition from the government and all parties aside from the left. Chinese car makers lost ground in Europe in October, slipping back from the record market share they captured a month earlier across the region. In the hybrid categories, where manufacturers like BYD have been on a tear, their share as a group fell around 3 percentage points to 12.6% from September's peak. That's according to researcher Dataforce. New EV registrations, a core category for Chinese brands, declined to 11.8% from 12.6%. Coming up, Airbus warns of travel disruption as a software issue hits thousands of A320 planes. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making the news this Monday. The data centre that supports the CME Group derivatives exchange says it has bolstered its backup cooling capacity after overheating sparked a 10-hour outage on Friday that roiled world markets. Cyrus One owns the facility in the suburban town of Aurora. It's about 80 kilometers from Chicago. It says stable and secure operations have been restored with additional redundancy added to the cooling systems. A London government watchdog wants tougher rules on building data centres, warning that their power demands may impinge on the construction of new homes in the crowded capital. Prime Minister Keir Starmer has promised to fast-track planning approval for data centres and ease access to the power grid to encourage investment in the UK economy. But balancing that priority with another key pledge, new housing developments that need to tap the same grid connections, is challenging in power-hungry London. And Keir Starmer plans to give a speech today defending the choices made in Rachel Reeves's £26 billion tax hiking budget. According to advance excerpts provided by 10 Downing Street, the Prime Minister will say that the budget reduced cost of living pressures and ensured economic stability. He will also pledge to cut Britain's growing benefits bill, which rose further at the budget with the move to lift the two-child benefit cap. Now, airlines across the world have been racing to keep their fleet operating after being forced to carry out an urgent software update on one of Airbus's most widely flown aircrafts. The company revealed the fault on its A320 risked corrupting computer data that helps maintain flight controls. We're joined now by Bloomberg's managing editor for space and aviation, Benedict Kamel. Benny, what has the impact been then of the fault so far?
So thankfully, the impact has been fairly minimal. This came out on Friday late in the European hours. Airbus coming out with a fairly short statement saying that, as you said, there were issues with the current version of the software on the A320 family, and that operators would have to urgently reverse to the previous version. That happened over the weekend. Most airlines that we spoke with and that came out with releases said that they had managed to do so. There were some delays in places like India, in Australia, sometimes in the US. But by and large, if you look at the size of the fleet impact, it was more than 6,000 aircraft. Actually, airlines managed to get this under control fairly swiftly. We heard from some yesterday saying that the very vast majority of the planes have reverted to the previous software and now are considered fit to fly again.
And Benny, you've been charting, of course, the Airbus delivery target story and how this ties in. Is there an impact on whether or not they can meet these pretty ambitious delivery targets for the year?
Well, it's too soon to say, given this just happened about 48 hours ago. But, you know, the last month of the year, that's really where the race is on. They have to meet a target of about 820 deliveries. And really, everything has to fall into place just perfectly. And the last thing you need in that sort of a situation is a distraction of this kind. So we'll hear in the next couple of days whether there's been any impact, also whether there's been any cost impact. Airlines might be coming to Airbus asking for compensation for cancelled flights or the cost of the software upgrade. In some cases, about 1,000 older aircraft, there's a hardware fix involved. So that, again, will probably bind some kind of engineering capacity. So all of these things combined, as I said, an unwelcome distraction. Whether it will impact the delivery target, we'll have to see. We hope to hear from Airbus in the next couple of days on this, but it's certainly nothing that they were hoping to see happen.
OK, Bloomberg's managing editor for space and aviation, Benedict Kamel, with that update. Benny, thank you. There's a lot more coming up. We're going to give you a touch in terms of the run-up that we've seen in silver prices and some of the asset classes on the move. We think, look, gas, for example, and defence stocks as we continue to focus on those peace talks between Ukraine, the US and Russia. Of course, Steve Witkoff of the US heading to Moscow, potentially as soon as today. There's a lot more coming up. Stay with us. This is Bloomberg.
We had a great Treasury auction, interest rates went down. And so I think that the American people could expect President Trump to pick somebody who's going to help them, you know, have cheaper car loans and easier access to mortgages at lower rates. And that's what we saw in the market response.
OK, White House Economic Director Kevin Hassett speaking to CBS Face the Nation on Sunday after President Trump says he has decided on his Fed pick but would not confirm the name. Scott Bessent, the Treasury Secretary, who's been involved in the process, has said we will get a name by the end of this month. Here's where Polymarket on the betting odds thinks things are lying, and they think that Kevin Hassett is firmly the front runner. This probably largely due to Bloomberg reporting that Kevin Hassett is indeed at the front of the pack as things stand. You've got Walsh there, of course, in the yellow line, Kevin Walsh, and then Chris Waller of the Federal Reserve himself. And you can see his prospects, in terms of the betting odds at least, have plummeted as Kevin Hassett's have jumped. So we'll see if that gets confirmed in the days and weeks ahead, as signalled, of course, and what it means for Fed policy going forward. And that's a key question as you think about the fiscal stimulus that comes through for the US next year. Let's flip the board and have a look at the silver price. This is currently, you can see, we're going to get to Ukraine and the impacts of those peace talks. But silver is remarkable in terms of the run-up. It's actually outstripped gold. So the gains for silver outstripping gold, and by some margin, doubling in price year to date. And that ties into the Fed story, because partly it is down to expectations of additional rate cuts from the Federal Reserve, partly down to a supply squeeze. In fact, you saw a record amount of silver coming into the key London market in October, and silver being held in the US on concerns amongst some that maybe there will be tariffs imposed on silver into the US market. So all those dynamics coming to play to force prices higher to record levels for silver, and again outstripping the gains year to date for gold. Let's go to that chart now that talks and focuses in on some of the asset classes that could move if you get substantial progress when it comes to the peace talks between Ukraine and Russia, as Steve Witkoff heads to Moscow, of course, and after those talks in Florida. So keep an eye on natural gas prices. Those have fallen already. Defence stocks as well coming under pressure. So that story and how it evolves on the back of any detail, with all the caveats, of course, around the contentious nature of these conversations, to be in focus for you. Defence stocks and natural gas prices that have come off in light of those negotiations. Now, to access, search and save all of these Bloomberg terminal charts used on the show and across Bloomberg TV, terminal subscribers can now use the brand new function Chart TV Go, CHRT TV Go on the terminal. The opening trade is up next. Stay with us. This is Bloomberg.